Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class was never out of session because the learning never stops. And so today what we're going to do is we're going to talk a little bit about using installment sales when you're selling property or a business. This is something that's very common that we tend to do a lot in the accounting world, and part of the reason why is it kind of gets into a little bit of accounting theory. And so there's two different types of people, if you want to think about it, or two different types of ways of doing accounting, predominantly within the field of tax. The first way is what we call the accrual method, and then we have what we call the cash method. Okay, so the accrual method is kind of what accountants do. You know, we have debits and credits, and the goal is to take 7 sort of philosophies that we have and basically say, look, according to these philosophies, this is how we're going to match things up. Because one of the problems that we run into when we see people doing the cash method is that things don't always line up. We're more worried about when cash is received rather than whether a transaction is actually taking place. And so under the accrual method, installment sales are actually very easy and they're done frequently. And so, you know, there's a method that they do under the installment method, but it doesn't work well for cash method people. And so when you're talking about doing an installment sale under the cash method, there's certain rules and procedures that normally happen. Now, why is it we predominantly do these in the cash method? Every individual, with the exception of very few people, are always on the cash method. Okay, and most small businesses are always going to be on the cash method also. So it's always going to be dependent upon when you get the cash that income is going to be received. And so what happens is then, so say for example, you take something that's really huge, for example, a building, a business, you know, a piece of land, something that will cost, you know, somewhere, sometimes up in the upwards of tens of millions of dollars. You may not have the ability to collect $10 million all at once. And so you cut a deal with the other person and say, look, you don't have $10 million, I'll make a deal with you. If you give me $15 million over 10 years, we'll go ahead and we'll recognize that as a sale. And so you transfer the title, and then there's usually what happens is there's a note, and that note, which is a legal document that gets written out that basically says, you know, it's basically a note is a fancy word for an IOU. All right, so they owe you money, and they're going to pay you the money, but, you know, of course, we have to have, you know, we have to have terms and understandings in order to do that, which is why we do it in a legal document. Now, from a tax perspective, what happens is you're not going to recognize the full income on the sale of that asset until cash is received. And so as you're receiving cash, you're going to recognize income. And there's a very fancy process that we could go over. We'll talk a little bit about some of that stuff. And you know, the actual mechanics of what goes on, of course, is not part of this video. These videos are really more to talk about theory and how we do things, so that you get the questions to go back to your tax preparers or your CPAs, your EAs, or your tax attorneys, and then you say, hey, look, I was listening to this bald guy on YouTube, and he was saying something about installment sales. Can we do that for this asset that I want to sell? Okay, so the goal is not for all of this, you know, to teach you and to becoming tax experts. That would take an exorbitant amount of time. It cannot be done on YouTube videos. I mean, I had to go get a master's degree in tax, and there are lawyers who go, after law school, they go get master's degree concentration in tax. So that could take them 5, 6, 7 years over the period of time that they actually learn everything they're going to learn. And I guarantee you, when you come out of school, you don't know half of it yet. It's usually experience, trial and error, and doing things right through research and dedicated study of the subject. Getting back to the topic at hand, however, so basically what ends up happening is we calculate what's called a gross profit percentage, and basically what that is that we say, look, you're going to receive, you know, $15 million. How much did you buy the land for? Well, if you bought the land for, say, and we'll just make it real easy, you know, we'll say that you bought the land for, you know, $500,000. So you're selling it for $10 million. Yes, you're going to collect 15. We'll deal with that in a second. But you're going to collect 15. You've sold it for 10, and you bought it originally for 5. So what ends up happening is you will recognize a capital gain on the delta between the $10 million and the $5 million that you originally bought it for, which would be a gross profit percentage of 50%. Okay, And so then what ends up happening is, as you are collecting the cash payments, you are going to recognize 50% of the gain that you would have at the start of the transaction as you're receiving those cash payments. Now, in theory, you're going to be receiving those cash payments over an equal period of time. There's nothing to really worry about with that. And there are definitely fancy ways to figure all this stuff out. But under the installment method that the IRS uses, it's actually relatively simple once you get the process going. I think setting it up is actually 100 times more difficult than the actual application of it once it's been set up. And so what happens is we set it up, we get the gross profit percentage, and then we move forward as we're collecting cash payments. Now, you said, well, wait a minute, Kevin, I'm getting 15 million, not 10. So what do I do with that other 5 million that I'm getting? And essentially that's going to be interest. And so you will have to recognize interest income on that collection of that $5 million as you're receiving it. Now, what will end up happening is you'll figure, and in that case, it's actually a pretty easy calculation also, because your interest payments equal to your gain payments. So, you'll recognize half of it as interest income and the other half of it is gain recognized. All right, so that's a pretty easy thing. And we usually do that by ratio also, because we just say, hey, look, the payments that they're going to receive over time is going to be X. We just sort of pro-ratedly do it. Now, you really want to get fancy with this, we would calculate an amortization table, do all sorts of things, and some CPAs will do that. I've done it because I knew it was a better interest to my client. And so as cash payments are coming in, we're recognizing interest income over the period of time based on the amortization table. That only works if you're getting regular payments and people are paying relatively on time. If you have people who basically say, okay, I'm going to pay you, $1 million a year, here's my check in January 1, and then the following year they don't get it to you until April, you're going to be, the income is going to be very difficult to calculate and do so appropriately. So what will end up happening is it's all facts and circumstances. We could do it based on ratios. We could do it based on an amortization table. We can also do it based off of some other methods, but I won't get into those here because I'm already running long as it is. Okay. So a few things that you got to understand. Number one, the installment method is not available to the extent that the gain on the property is treated as recapture of any depreciation that you have taken over real or personal property. Thus, that portion of the gain is recognized at the time of sale, and you do not, even if you do not recognize cash at the time. So most assets are subject to depreciation. Now, we haven't gotten too much into depreciation. We did a bonus depreciation video, but we didn't talk about depreciation as a whole. I kind of talked about that if we did it, it'd be a huge video, and this is, an example of that. If you sell property and you get a depreciation deduction, which is an ordinary income deduction, the IRS kind of looks at it and says, well, wait a minute, if you turn around and you sell it, we're not going to give you a capital gain, which is usually at a lower rate, on the income that was generated because you took these depreciation payments. So if you sell it, you have to do what's called a recapture. I don't want to get into it any more than that at this point, but basically that recapture income is recognized gain immediately. So you want to make sure you're working with your tax advisor, your CPA, your EA, or your tax attorney, to make sure that they're recognizing that, and at least that you're fully aware of what's going to take place as a result of all that. Also, in order for the gain to be deferred, the buyer's debt cannot be payable on demand or readily tradable on an established securities market. I.e., if you're basically saying that I can assign this note to anybody I want to at any time, it's no longer, it's basically a readily tradable asset. And so what ends up happening is the IRS is not going to allow you to do this. This is sort of what I would call the gray area, though, because what is readily tradable on an established securities market? That's going to be bonds for the most part. It's going to be other types of debt. I mean, there's not really a market out there for a lot of this type of debt, and definitely because what's going to happen is there's going to be regulations that you have to uphold in order to be able to have it regularly tradable. So that they're just what they're trying to do is they're trying to just make sure that it only applies to, individuals, small business individuals, small business owners who basically want to get, you know, favorable or get the treatment of this correct in line with the method of accounting that they have, and that's the cash method. The installment method cannot be used for certain sales of certain property, such as most sales of property by a dealer or sales in a publicly traded property, such as stock or securities. And that's just, you know, kind of preventing you from saying, well, I'm gonna do the installment method as I'm selling, you know, my IBM stock. Now, that doesn't mean that you can't do this for small business stock. I remember there were at least 2 or 3 engagements that I've done in my past time where, you know, one of the owners decided he doesn't want to work for the company anymore, and what he does is that he says, I'm going to sell my stock to my, you know, family members for $1 million installment sale. They did it over, I believe it was 7 years. And then, you know, grandpa, you know, received a retirement income while the children are buying his stock out from him and taking over the company. Perfectly legitimate way of doing things, and you can, you know, I mean, it was all sold at a gain, so the IRS is not going to disallow it. But basically what ends up happening is you want to make sure that you're setting these things up right and that you have somebody who has experience in dealing with them. Also, once the installment sale is made, subject to certain exceptions, says transfer of spouse or death, a transfer of the buyer's debt will result in recognition of deferred gain. So in other words, if I, you know, say for example, I have this note and I'm receiving these payments. Somebody comes to me and says, Kevin, you owe me $700,000. I'm like, oh, well, I have this note that I'm receiving periodic payments on. Why don't I just give you this note and say it's not for, you know, the $10 million, maybe this one was only for $1 million, I've only received a certain amount of payments on it. I say, I'll give you this note in settlement of the debt. And so what ends up happening is they'll take the note, they're happy, they settle the debt. You have to recognize the gain immediately. And the reason why is because you've received taxable benefit. And because you've received taxable benefit, you know, even though you may not be paying taxes on it, you have received a taxable benefit, and as a result of which, you do need to recognize the gain on that immediately. So that's all I have to say about installment sales on this video. Went a little longer than I would have liked it to have. But again, we love the learning around here, so we're going to continue doing it until the learning eventually stops, which it never does. So and continue on going on forever and ever more. My name is Kevin Matthews. I am the tax professor. Remember, class is still in session because that learning does not stop. If you want to reach out to me, you can leave a comment in the comment box below. You can also reach out to me at my website, and that's www.betasolutioncpa.com. That's www.betasolutioncpa.com. Something else I'd like to request, I've actually been avoiding doing this, but I've come to the realization that this might be something I need to do. If you're watching this video and you really enjoy it, do me a favor, go ahead and hit like, and if you can, go ahead and hit subscribe to my playlist. You'll receive, you know, of course, first time notification when new videos are coming up, and there's going to be a lot of them. I mean, I've got the pieces of paper all right here that has all of the videos, and if I showed you how many there are, there's going to be plenty of them, okay? This is going to be very valuable for you, and we hope that you get to use this in order to make your financial situation get better, but more importantly, to improve the relationship that you have with your CPA, your EA, or your tax attorney.